Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Molina Healthcare Inc. Annual Report. Molina Healthcare offers a range of managed healthcare services to underserved populations across the U.S. At its core, the company provides essential medical coverage to low-income families and individuals through various government programs. The company operates under 4 distinct segments: Medicaid, Medicare, Marketplace, and Other. The Medicaid segment caters to those who are eligible for state-funded health insurance, while the Medicare segment serves seniors and individuals with disabilities. The Marketplace segment offers plans through the Affordable Care Act's online marketplaces, providing a range of options for consumers. In addition to these core services, Molina Healthcare also provides other essential healthcare services, including pharmacy benefits management, dental care, and vision coverage. By offering a comprehensive suite of healthcare solutions, Molina Healthcare aims to improve the health outcomes and well-being of its members. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price crash. The stock price of Molina Healthcare, Inc. has crashed significantly in the past year due to several factors that have impacted the company's financial performance and reputation. One major reason is the decline in Medicaid enrollment, which accounts for a significant portion of Molina's revenue. As more states opt out of Medicaid expansion under the Affordable Care Act, Molina's customer base has shrunk, leading to reduced revenue. Another factor contributing to the stock price crash is increased competition from other health insurance companies. With more players entering the market, Molina faces intense competition for customers and market share. This has led to a decrease in premiums and profitability, further exacerbating the decline in stock price. Additionally, regulatory challenges have also taken a toll on Molina's stock price. The company has faced scrutiny from state regulators over its business practices, including allegations of improper billing and inadequate care. These regulatory issues have eroded investor confidence and led to a decline in stock value. Lastly, the COVID-19 pandemic has had a significant impact on Molina's operations and finances. The company has struggled to manage the increased demand for healthcare services while maintaining profitability. This has put additional pressure on the company's financials, contributing to the decline in stock price. Overall, the combination of these factors has led to a significant decline in Molina Healthcare, Inc.'s stock price over the past year. Molina Healthcare, Inc. market capitalization of $6 billion is materially smaller than most of its industry peers of roughly $34 billion. Molina Healthcare, Inc. trades at a lower price-to-earnings ratio of 14 times and a lower price-to-book ratio of 1.57 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. In terms of revenue growth, the Medicare segment stands out as a notable exception. The premium revenue for this segment increased by $566 million between 2023 and 2025, indicating a significant upward trend. However, it is essential to note that there is no explicit information provided about net income for the Medicare segment during this period. This lack of clarity makes it challenging to determine whether the growth in premium revenue translates into increased profitability. In contrast, the Medicaid segment experienced a decline in revenue growth. The net income for this segment decreased from $179 million in 2024 to $472 million in 2025, indicating a substantial drop in profitability. Unfortunately, there is no explicit information provided about premium revenue for the Medicaid segment during this period. The marketplace segment remains unclear due to the absence of any explicit information regarding net income or premium revenue. As such, it is challenging to determine whether this segment has experienced growth or decline in revenue. Net income and profit margins. A shift in trends. The net income of a company has undergone significant changes over the past few years. In 2023, it remained constant at $1,179 million, mirroring the previous year's figure. However, this stability was short-lived, as the net income decreased by $707 million, minus 37%, in 2025 compared to 2024. This decline is a notable change from the previous trend. Profit margins also underwent a subtle shift. Although no explicit percentage is provided for profit margins, it can be inferred that they remain stable due to the decrease in common stock purchases and an increase in other comprehensive income. The stability of net income despite these changes suggests that the company's profitability has been maintained through adjustments in its financial activities. The reasons behind this change are multifaceted. A significant decrease in common stock purchases by $1,000 may have contributed to the stability of net income. Conversely, an increase in other comprehensive income by $72 could be a factor in maintaining profit margins. These changes indicate that the company has adapted to changing market conditions and is working to maintain its financial health. The company's financial performance over the past few years has been a subject of interest. A review of its operating cash flow reveals some notable trends. In both 2024 and 2023, the company was able to generate positive operating cash flow, indicating that it was able to cover its operational expenses and generate excess funds. However, this trend did not continue in 2025. Despite efforts to maintain profitability, the company's operating cash flow turned negative, suggesting that it struggled to meet its operational costs during this period. This shift is a cause for concern and warrants further examination of the company's financial management strategies. Molina Healthcare's debt level and interest expenses have undergone some changes over the past few years. Initially, there was an increase in long-term debt from $2,923 million to $3,766 million between 2023 and 2024. However, this trend reversed in 2025, where non-current long-term debt decreased back to its original level of $2,923 million. Regarding interest expenses, the data shows a fluctuation in cash paid for interest over the years. In 2023, Molina Healthcare paid $108 for interest, which increased to $121 in 2024 and further rose to $181 in 2025. Despite this increase, the company's interest expenses are not explicitly stated on page 13 of the summary. Management has announced that the company will be exiting the Medicare Advantage prescription drug (MAPD) product for 2027. This decision is a strategic shift to focus exclusively on dual-eligible members in Medicare. The move does not reflect any existing conditions as of December 31, 2025, but rather arose subsequently. This change indicates a reevaluation of the company's priorities and direction, with a renewed emphasis on serving this specific demographic. Molina Healthcare's financial performance summary reveals some key information about the company's financial activities. According to the summary, one notable transaction occurred in the fourth quarter of 2025. The company made purchases of common stock under its equity compensation plans during this period. This indicates that Molina Healthcare has been involved in buying back shares as part of its equity compensation plans. However, there is no mention of dividend payments being made by the company. It appears that the primary focus was on purchasing common stock to support employee compensation and retention efforts. That concludes the financial summary for Molina Healthcare Inc. Feel free to comment below, and I will be happy to answer them when possible.